Today, the RBA decided to keep rates on hold after dropping rates by 25 basis points last month. Now, looking at the board meeting minutes from last month, it was a bit of a flip of the coin whether they were going to drop rates in February or potentially wait until March. Now, ultimately, we all know the outcome of that. They did decide to drop rates in February, so that would mean that we'd obviously see rates today remaining on hold. Now, the next time we're sort of going to see some pressure around rates could be still this side of the first half of the year. A lot of commentators are thinking maybe May, June might be the time, unless they see some deterioration in the marketplace. Now, let's get behind those numbers, and again, if you watched my video in regards to why they changed rates in February, you would understand that a lot of this has got to do with the business environment as opposed to the consumer spending. Consumer spending is actually going fairly well. We're obviously seeing prices in houses going quite well, and we're seeing forward construction around housing approvals is also, there's a lot of approvals in the pipeline as well. So that's all good for the general economy. But what we're actually seeing, just recently we saw some CapEx announcements come out around, business spending, and this is the real concern for most economists and most commentators in this space. What we saw in the December quarter was a decline in CapEx spending from businesses. Now, that was led mainly by the mining sector, but what we did see as a really nice positive was actually non-mining sector CapEx improved in the December quarter. Now, that's the first time in the last 5 quarters that we've actually seen some manufacturing or CapEx expenditure in that area. So that is a nice sign. The problem is, however, that in terms of the forward estimates and the forward outlook is that CapEx is looking to decline somewhat further. And we're sort of seeing both in the mining sector, naturally, we know it's still coming off its highs, but the non-mining sector is also struggling with confidence and sentiment. So the forward projection around CapEx expenditure is of a softer number. Now, that's not great. We also saw the RBA obviously made the right call. They knew something that we didn't around unemployment, and they obviously saw unemployment come in at 6.4% in the last set of data. Now, that's the worst unemployment rate since August of 2002. So we didn't get to this low even through the GFC. Now, that being said, we're actually seeing on the counterbalance of that is ANZ job ads and those type of things actually coming through. So really good numbers of inquiry and good job ads coming through. And here at Empower Wealth, we're also looking for new staff as well. So obviously our business is going well. Now, coming down to the final point we want to make around, the numbers and where we see where we see rates going in the short term. I'm still sitting on the fence to say rates on hold, and I know I did say that before the last cut. There's definitely a change around business confidence, and we need to see business get on board and start to invest in capital expenditure and also in expanding their businesses. That's an important message, and until we see that, we're going to fumble around with unemployment rate remaining stagnant and the overall economy probably underperforming. And the RBA knows that they've got inflation under control, so they do have the ability to push the lever again and take rates even lower. The only caveat to that is the property market. We've already seen clearance rates in both Melbourne and Sydney at really high levels, and we really haven't. We saw a slowdown coming into the end of last year, but now that rate cut has certainly spurred on more buyers. Interestingly enough, and I did say this prior, is that first home buyers had left the marketplace, but I didn't believe they'd left the marketplace in the numbers that were predicted. So in reality, we've seen the ABS adjust those numbers, and we actually do know that there's a lot more first home buyers coming into the marketplace. So it's important to understand that with those first home buyers coming into the marketplace, that's going to drive the consumer spending, and it may be consumers that lead us out of this current slowdown and business catching up as opposed to the other way around. Now, we need to see an enormous amount of lifting by the consumer market to actually, continue to see our GDP numbers get higher. So let's wrap it up. This conversation around interest rates is very much around business activity. It's not so much around consumer activity. Sentiment around, job security is still going to be there, and it's going to be a worry, but we need to see businesses doing more. If they do more, then rates remain on hold, and we'll see interest rates go higher probably into 2016. If not, and the Reserve Bank know that they've still got some more leverage in the monetary policy side of things, so we'll see interest rates go lower. How much lower can they go? Well, crystal ball gazing, But if they went further than another 25 basis points, it would surprise me immensely. But I've said that before, and I've been surprised before. You know, in this prediction game, you're not always going to get it right. So if interest rates do go lower, that's great for those of us who have got mortgages. But you know, for retirees and those people who've got money in term deposits, it's horrible news. So we might see some more activity into the equity markets, and also some more people coming into the property market from an investment point of view, because they're seeing better returns than what they're actually getting through the banks. Thanks for listening.